Today we are going to talk about the sequence of returns, the risk to your portfolio in your retirement years or your distribution years versus sequence of returns when you're in the accumulation phase. For a lot of people, when they look at financial planning software, they use average returns, and I'll show you why. As long as you understand how the software, then you'll be better prepared. At least your expectations will be met. So when you first start out, I always like to break things down into two different investing life cycles, right? You have the accumulation phase. This is when you're working. You can utilize a passive approach. Most people in their 401k, for example, they pick a portfolio or they'll just use target date funds, and you're just over many years just contribute into that 401k, right? Every pay period, you're contributing a certain amount, and that's where bear markets are actually your friend because of dollar cost averaging. So if the markets are down, let's say 50%, you can buy twice as many shares as you could prior to that. And I had a client, or at the time he wasn't a client, wanted me to look at his 401k. So we sat down, I said, gave him my recommendations. About a year later, we were on the phone just asking him how things were going. And he said, well, the last few months I just stopped contributing to my 401k. And when I picked my jaw up, from the table, then I was like, why would you stop contributing? And he said, everything that I was putting in, I was losing. So I just stopped contributing to it. So it was at that point that I realized, number one, I wasn't explaining it clearly. And since then, of course, you're accumulating shares, not just putting money into something. You're buying shares, so you have to think of it in that fashion. If the markets are down, you're getting it at a discount, and you just keep doing that over many years. And those discounted shares during the bear market, as it moves higher, will increase, compound your wealth over time. So, and during this time period, sequence of returns in your accumulation phase don't matter. The end point is going to be the same. And we'll get into that in the definition now. And so what I did is I took the S&P 500 and I went back to the year 2000 and went through the end of last year, sorry about that, through 2023. Here are the returns. And these are the actual returns of the S&P. So you can see in 2000 to 2002, we had a bear market. This was the tech bubble when it bust. 2008, this was the financial crisis. And we all know that the peak of the market was October of 2007. The bottom was in March of 2009, and it was down over 50%. But for that 1 year, the S&P was down 38%. Then we went on a strong bull market. A lot of people say it ended in 2022. I don't believe it has. I think we're still in that bull market. So, but you can see you had a strong bull market at the end and a couple bear markets at the beginning. And why is that important if you were in retirement? So this next set of data is the exact same data. I just transposed it. So now we have 2023 at the top, ending in the year 2000. And those returns now, strong bull market initially, then two bear markets in the end. So looking at that, these are the sequence of returns, and all I did was flip them. So again, in one scenario, it's bear markets initially. In the next scenario, it's bear markets towards the end. And this is the data. So you can see the transposed data. You had the bull markets initially. This right here is the financial crisis. This is the tech bubble. Here's the same thing. Now you have the tech bubble and then the financial crisis. But you can see during that accumulation phase, there was no difference. You started with 500,000 and you both ended with a little over 1.5 million. So the average return on this sequence is 6.67. So during the accumulation phase, it didn't matter. The end results are the same. So when you go into the distribution phase and money's withdrawn from the portfolio, you got portfolio losses during the early years. They can be devastating to your retirement income stream or your standard of living. And like I just said, the average returns don't matter. The sequence of returns do. So when you're in that distribution phase, the averages, you just need to throw those out the window. You need to really pay attention to that sequence. There's no way to know what the future holds. You just have to prepare yourself and properly plan for it. So on this next chart, it's the exact same data, except in this situation, both portfolios were going to withdraw $25,000 a year, which is 5% of the portfolio. And what you see here is the sequence of returns absolutely matter. If you went through the bull market phase initially, you started out with $500,000 and you pulled $25,000 a year, at the end of this time period in 2023, you would still have over $800,000. So you netted $300,000 on top of pulling out $25,000 a year. If, however, you went through the 2000s in the way the data actually came in, bear market initially, and then it rallied up, but since you're taking money out, the markets broke even in 2007 and then sold off 50% again during the financial crisis. But because you're pulling money out, you never break back even. You're reverse dollar cost averaging out. And so in this situation, it was the year 2018 and the portfolio was completely depleted. That's why the sequence of returns matter, and average returns when it comes to retirement planning do more harm than good. So again, distribution phase, you need to really focus on risk management as opposed to maximizing returns. The entire financial industry is always, is talking about, well, we can maximize returns for a given level of risk. You really just need to focus on risk management. Now, this is not advice. Everybody is different. If you've got millions of dollars, then your situation's a lot different than someone that has $1 million. So in this situation, sequence of returns absolutely matter. Bear markets are your enemy in this phase because you're reverse dollar cost averaging out. Your investment strategies, you really need to develop your portfolio in a way that you still get decent returns. You're not trying to beat the S&P 500. You just want steady returns that outpace inflation over long periods of time with reduced drawdown, which just means you reduce the actual risk to the portfolio, not just standard deviation. So we've already hit on this. Financial planning software, because it uses averages, you'll see it runs Monte Carlo analysis. Most financial planning software, at least the softwares that I've looked at, runs Monte Carlo, which is several different iterations, thousands of iterations over different sequence of returns and all that, and gives you a probability of success. But then when you go and look at the cash flow side of it, or even the tax planning side of it, then it just uses average returns. So it's as if you never had a down year. You just had an average of, say, 7%. When we know you had, like the data showed, some years were in the 20%, some were negative, but on average, it was 6.67%. So financial planning software doesn't take into consideration sequence of returns, only in the Monte Carlo analysis. So how can you minimize the impact of the sequence of returns? Well, there's a couple things that you can do. Number one is the portfolio management side of it. So that is building out your investment management strategies in a way that focuses on risk, and returns are secondary, but still very important. But your primary focus is risk. You don't want to get yourself in a situation to where you're having to dramatically reduce your standard of living. The other thing is just an income plan. So there's financial planning software that says, am I going to run out of money? Here's the probability of success on that, or the probability that that could happen. Then there's income planning. And what that looks at is, how much can I spend? And are there any rules or a strategy in order to manage my income so that over long periods of time, I'm not gonna have to worry about lowering my standard of living. One thing that we utilize is just cash management. So for some people, and everybody, again, situation is different, but 1 to 3 years in a cash management strategy. Now that doesn't mean just put it in cash, put it under the mattress. It just means in really, really low risk, sometimes like now with the higher interest rate environment, treasuries, US government treasuries, laddered over that 1 to 3 year period. But you're this way that if the markets do go down, you go through a tech bubble, you go through a financial crisis, you still have this 1 to 3 years of income. So you'll start drawing that cash management strategy down. Then as the markets recover, you can replenish that cash management strategy. So you're always going to have that 1 to 3 years within the cash management portfolio to pretty much insulate your income distributions. And then in good markets, you're able to replenish that cash management. And then what we like to utilize is guardrails. So not only do we utilize a cash management approach, but then we'll sit down and it gives clients that visual where they can look and say, okay, if my portfolio grows by this much, then I can increase my income by X. If my portfolio falls by this much, then I need to decrease that distribution by X. And in that situation, you're really trying to maximize what you're able to pull out of a portfolio over time, and at the same time, not running the risk of running out of money. So those are a couple ways to minimize that impact. And if you have any questions, feel free to shoot us an email. You can go to our website and just schedule a no-cost consultation if you'd like us to look at your portfolio or help you develop your own income plan or retirement plan. And as always, there will be a link in the bottom for you do-it-yourselfers, and you do have to register. That's just how the software is, but it's just like any other software. You click on the registration link, put in your information, and then you have access to that software, and you can do basic financial planning. You can look at what I was just talking about on the cash flow side of things to where it just shows that average return as if you never had a down year. If you're interested in that, just click the link below. And until next time, guys, choose your advisors wisely. Your financial health depends on it.